where I can see my notes and all of your shining faces. Morning, everybody. Thanks for coming. So yeah, we're going to talk about charity. And you heard Jim say I was a writer. You have a text that goes along with this presentation. And I will probably tell you, I feel like the slides should guide the presentation as opposed to being the presentation. So most of the detail, most of the sites, most of the authority are going to be in your text. We're just going to go through it. Charity can be complex, and so there's a lot of material to cover in just a 2-hour segment, but we are going to get through it all. But we're going to hit the surface, and the detail, a lot of it's going to be in the text. We're going to review the legal framework that makes charitable contributions tax deductible. We are going to identify some common and less common options for making tax deductible charitable contributions. How many of you were in Brad's retirement thing yesterday, his session? Yeah, he mentioned QCDs. We're going to talk, if you haven't worked with QCDs before, we're going to talk about those. Those are qualified charitable contributions made directly from to satisfy an RMD requirement. We are going to review the rules for substantiating the tax deductibility of a charitable contribution. You may know, you may not know, you may be always erring on the side of caution and getting the max amount of substantiation that you need to when you might be able to make do with less. It just depends, like so many other things in tax. And we're going to identify a few planning opportunities related to charitable contributions. And I'm sure some of our sponsors, I think, have given presentations much more specific to this. Again, we're just going to hit the highlights. So let's talk about the what and the why. On July 2nd, 1909, the 16th Amendment was passed. What was the 16th? Income tax. Shortly after, it was ratified. But you notice it wasn't immediately ratified. Revenue Act of 1913 created tax-exempt organizations. The Revenue Act of 1917 was the act that made charitable contributions tax deductible, but it only made them deductible for individuals. It wasn't until 1936 that corporations who donated were allowed to take a deduction for their charitable contributions. So why do you think that was? Look at the timing. Yeah, the Great Depression. So it was helping the corporations. It was also, much like during the pandemic, encouraging that philanthropy on the part of organizations. So deductible contributions have been around basically for 100 years or more for individuals. Wow, that's small. Can you guys see that? Okay. A charitable contribution to be deductible. I always tell people when they ask, well, I want it, here I am moving around behind the, I always tell people when they ask, well, I want to donate to so-and-so. You can donate to anyone that you want. You can donate to any organization that you want. Just like you can pay for any expense you want out of your business's bank account. But you can only deduct certain items. Has to be made to a qualified charitable organization. Those are defined as churches, public schools and universities, museums, federal, state, and local governments, there's a little caveat there, and sometimes private foundations. So on the federal, state, and local governments, the thing with a qualified charitable organization is that the gifts have to be for public purposes, and I put an example like a park. It has to have a component of, I'm looking at my notes here because I had the perfect words for it. It's probably in your text. For public benevolent purposes was what it was. It can't just be oh, I'm going to make a donation to the government to pay so-and-so's taxes. No. Public parks, I'm going to fund the bike paths, I want to donate to the library, these types of things. Private donation, oh, it's right there. Gift for public benevolent purposes. Duh. Jeez. All right. Important to remember. Do we have new EAs or new tax pros in here? No, you guys are all really experienced. Nonprofit, tax exempt, and charitable are three different things. 501c3, we always hear it. Do we really know what it means? 501c3 means that is a legitimate, charitable, qualified charitable organization. You have to apply to get the status. You all know that. You've probably done it for your clients. 501c, everything else. There are 29 types of tax-exempt organizations that are listed in the IRC. Why is this important? Why am I telling you this? Because your clients don't always know. Your clients who are nonprofits and may be tax exempt don't always understand and may be out there telling their members or their donors that they can deduct this. Oh, I don't keep real good track of my photos, but the homeowners association that lives across the street from me, yeah, he's shaking his head. He knows where I'm going with this. Big sign in January. Your dues are tax deductible. No, they are not. And I took the snap of it, but of course it's lost to eternity in the cloud. But your clients and your homeowners, your clients that are tax-exempt entities, they don't always know unless we tell them, hey, I just want to remind you, make sure that when you're communicating to your members that their contributions are not tax deductible. It's not just about our clients. Sometimes it's just about what we do as EAs is educate the public that sometimes what they hear isn't the whole truth or isn't even the truth at all. Charity has to be a gift for public benevolent purposes. Keyword in there is public. Most of you know this. GoFundMe and other social media fundraising things, unless they are tied to a 501c3, they're not public. Therefore, they're not deductible. Private schools, this is a big one, especially where I live. Even if they're nonprofit and tax exempt, they're not public. Where I live in New Mexico. There are a lot of parochial Catholic schools. You can make a donation to the Catholic Church, tax exempt. You make a donation to the private school, not necessarily. And then, of course, oh, well, I pay for my kids' uniforms, my books, and blah, blah, blah. Or no. All that crazy stuff comes in. Social clubs, business clubs, fraternal organizations, political organizations are often nonprofit and tax exempt, but they are still not QCOs. Now, there's an exception. Sometimes the organization will have a sub-organization that is actually organized as a qualified charitable organization. And this is why you see, and I'm going to use one that some of you may have heard of. You know what Mensa is? The high IQ thing? Okay. So Mensa is basically a social club for smart people, really, really smart people. They have a research foundation that is a sub-organization. So are your Mensa dues deductible? No. Are contributions you make to Mensa deductible for their party fund deductible? No. But if you contribute to their research foundation, that's a different organization. It is qualified as a 501c3. So when you're looking at, especially when you have philanthropic clients that are making large donations, the takeaway here is not to always discount this out of hand, to make sure that you're doing the deal. Oh no, you can't donate. You can't donate to Mensa. That's a social club. But if you dig a little deeper, you find out it's their research foundation, and that is actually something where that part can be deductible. I'm going to throw out a code section out here because it says private foundations sometimes. And this is a 2-hour class, and it is not a deep dive by any stretch. IRC 508E has a specification for when private foundations are tax exempt and when contributions to them are deductible. If the state's laws that organize the foundation jive with the IRC, they're usually going to be qualified under 508E. Also, there is a link in your text to that. How many of you are using the PDF version of the text? Anybody? I know that Emily, the NYSSEA distributed the PDF version to everybody? Okay, yeah, so the handout PDFs, the links in there are live. Anything that I could link directly to a source that wouldn't charge you, that wasn't paywalled, is linked, and so you can go directly there. I think this one goes to Cornell Law. Do you guys know about Cornell Law? Yeah, great place to have, and your contribution to Cornell Law to help them keep that tax code up there free on the web for all of us is tax deductible. Here's some of the rules for private foundations. They're a subcategory. Oh, I just did all this. You got to adhere to the state laws that satisfy IRC 508E. And Revenue Ruling 75038 has a list of states whose laws meet the criteria. One thing you want to know, and I covered this in yesterday's class, is often if you have a paper copy of the revenue ruling or you're looking at an old PDF of the revenue ruling, things change. And so it's always best to check the IRS website to make sure that, state has not been added, has gone away. And that's a great one. And I was thinking of the Education Foundation and I lost the word. Okay. So yeah, NAEA has one of those subsidiary organizations that those donations are tax deductible. Now, again, as Henry points out, we can argue, are they a deductible business expense all day long? But if it's not a business expense to you, if you're done working and you just want to stay a member, are those dues deductible? No. But again, donations to the Education Foundation. There's any number of larger organizations that have a research arm or an education arm that are going to, where your deduction or where your client's deductions are going to be allowed. So, eligible donations. They have to be made of disinterested generosity. It's a gift, okay? And that's one of the key rulings. Your text probably talks a lot about what makes a gift, and there's a very famous tax court case called Duberstein where somebody gave someone a Cadillac, and was the Cadillac deductible? And Duberstein's famous for a number of reasons, one of which is it's very hard to give a gift to an employee or a former employee and have it not be some form of compensation, but it also talks about that disinterested generosity. Obviously, to be eligible, it has to be made to a QCO. It has to be within the applicable limitations and the threshold for the type of donation it is. And that's really vague because we're going to get into specifics in some of the later slides. But there are limitations. Sometimes you will have a relatively high income person make these huge donations and think they're going to be 100% deductible. You also will sometimes, if you have a larger practice, if you don't have long-term clients that you know really well, have people that think a tax-deductible donation equates to a tax credit, a dollar-for-dollar reduction in tax. And again, here's where you talk to me, you're going to get the practice management best practices stuff. We sometimes forget, because we live here, that our clients are not born knowing this stuff. And even our longtime clients can forget the mechanics of Form 1040 and how things work. Brad mentioned yesterday how many people don't know or have forgotten that our tax system is progressive. It steps up. Just because you hit that 24% bracket doesn't automatically mean that all your income is taxed at 24%. I had to explain that to some Mensa level rocket science clients who were high income W-2 earners. They're brilliant. They had no clue. Same thing with charitable contributions. It's really important, especially for people who aren't regularly philanthropic. They come to you at the end of the year. Well, what if I make a donation? Or you get that big balance due, or you're doing their estimated tax, you're finally doing their estimate calculation. They're like, well, what if I make a charitable contribution? Can we bring that down? And it's like, you're spending money and you're not getting a dollar for dollar reduction. And you guys are nodding like, duh, Amber, except I'm telling you, because we're not always good at this, communicating this regularly to your clients will add value to the engagement. Your clients will begin to see the value instead of thinking they can swap you out for, one of those things, like the ad says. And obviously, what else does it have to be? It has to be substantiated. This is a huge, huge failure point. We'll get to that later. Ineligible donations, we've talked about this. Private individuals, GoFundMe. Yeah, I had a client once, I gave my babysitter my car. Can I deduct that? No. Can you donate services and take a deduction? No. We'll go over the what and the why on that later. Most of you know that. Most, but not all donations to foreign organizations. There are exceptions for foreign organizations that are organized in Israel, Mexico, and Canada. Now, before everybody starts doing the happy dance, to be deductible if you are making a donation, and I say you, but your clients. If the deduction or if the contribution is being made to an organization, Canadian, Mexican, or Israeli, there has to be an income tax treaty in place. And you're on, yeah, Amber, duh, we have, again, all good. No, the taxpayer has to have income sourced to that country. And that's a potential huge failure point. Is, we have an income tax treaty, and I heard income tax I'm contributing to this organization in Israel, or I'm contributing to this organization organized in Canada, and I heard that that's deductible. Well, do you have income sourced to Israel or to Canada or to Mexico? Henry. That's the next thing, is the foreign organizations. And if you've done this, Henry's absolutely correct. What he said was a lot of the Israeli organizations have a U.S. organized branch, much like the Research Foundation. Doctors Without Borders is a big one. They're French or Canadian. I can't remember which. French? Okay. Are they Québécois or are they French? Okay. That's why I couldn't remember, because it's, Médecins Sans Frontières, and it's like, I can't remember. Is that Quebec or is it actually France? In any case, if you go out to the Doctors Without Borders website, and I would expect that if you were doing this for one of the Israeli organizations or a Canadian or a Mexican organization that was soliciting donations from U.S. taxpayers, most of them are going to say, where are you located? What country are you donating from? And they will direct you or redirect you to the organization that is organized here in the United States. Again, important for you, especially for those of you with older school type, write a check and mail it clients, to make sure that they are getting that to the proper organization to make that deduction make that contribution, actually deductible. There is something else that will make your donation eligible. You can't get anything in return. It goes back to that disinterested generosity. If you're getting a state or a local tax credit for making that contribution, the contribution has to be, you can't double dip it, okay? You got something for it. It wasn't entirely disinterested generosity. You have to reduce the amount of the contribution by the amount of state or local tax credit. And I'm going to give you guys the reg for that. Prove it, Amber. Regulation 1.170H3 is where you're going to find that reg about reducing the payment for the amount of double dip. I don't know how many of you guys have to deal with this, but I have engineers as clients. I have literal rocket scientists as clients. That's not what I heard. Prove it. Okay? So I like to always throw out the authority when I can, because I have really twitchy clients that get kind of bossy with me. So let's do a yes or no's. I expect 100% accuracy on this from this esteemed group. Yes, sir, in the back. That is correct. So y'all know, now credit cards are kind of nice for this, okay? Because a credit card will do the conversion for you. You all know that the IRS has the prior year conversion to and from. And I've got it bookmarked. I love that thing. If you do a lot of foreign, I've been told this. How many of you know Beth Logan, American Expat Tax, and Susan Anderson? Yeah, they're kind of like, I don't know, somebody starts talking foreign to me and I'm just like, go talk to them. They will tell you that there is often a benefit to not using the IRS end of year currency converter as far as converting amounts that were paid or accrued as income because of changes in currency. For a charitable contribution, depending on the size of it, there may not be enough ROI to kind of parse all the detail. You just throw it in as it was made sometime this year. We're going to call it 1231. Yep. Again, so what Henry said is that if you're using the IRS chart and the item gets examined and you can prove it, the IRS will take that off the table. However, if you are using a more complex timing method for currency conversions, you better have your ducks in a row with respect to documentations and where you got that information. Okay, I'm not opening that can. I'm already on my soapbox, so I'm not going to go into training the IRS staff. That's good. Very good to hear. So, okay, we talked about the forum. We're good. Okay, so I expect 100% accuracy here on this slide. Let's hit it. Raffle tickets. Why? Okay, so we all know, but again, I deal with engineers and rocket scientists. Why? And toddlers. Why? Expectation of something in return. So what is that? What are you buying when you buy a raffle ticket? A chance. So what do we have here? Gambling or wagering. If you win, the ticket is your basis. So if you win that, $50,000 bass boat, that $100 is your basis. Henry, he brings up, can you backdoor the Cohan rule using ChatGPT? That was yesterday's weird thing. I've got a list of weird stuff from Henry that I get to go home and play with. I'm going to take a look at that. Okay. Ooh, let's add it to my list. All right. Clicky, clicky. Event tickets. Well, I'm an alumni from blah, 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 so I always buy season tickets or I get me a box at my college, and they're a 501c3. Are my season tickets? No, they're excluded. They are absolutely excluded. Yeah. Seating rights, also a nope. It's like the option. I have the option to buy tickets at the whatever's game. Athletic tickets or seating rights. We just did that. No. Events, athletics. All of these have been asked and answered repeatedly in the courts. I'm less active on social media because I find it's causing my mental health to deteriorate, because asked and answered, and I get on there and I've read court cases and court cases and court cases, and I say, no, you can't do that. And then the tax pros argue with me about, well, I've been doing that for years and never got caught. Again, it's not can you do it, it's will it stand up? Can you defend it? Apparently not, Henry. Why would you say that? I've been doing this for I've always done that. It's never been they won't say never gotten caught. They'll say it's never been a problem. You are Russian audit roulette. Okay, next one. Oh, we had this auction item. I didn't. The bottle of tequila Matt donated at the NAEA auction. Is that deductible? I paid my $50 for my tequila. But it was part of a fundraiser for the Education Foundation, which may or may not have been, but let's say arguably that was a fundraiser for the NAEA Education Foundation. And was that deductible? Why? You got something for it. You don't usually have income, but I guess, and if you did, it was usually going to be negligible. You just have to drink the evidence. You paid fair market value, willing buyer, willing seller, so I doubt that I would be arguable you didn't have income because you paid fair market value. The auction person decided that the bidding started here and anything after that was gravy. So the auction item itself, no, you got something in return. However, there are circumstances, you know how those things get. They get heated. People get excited. Sometimes, I was at an auction once. I was a volunteer for a local museum. Somebody donated a bottle of Blanton's. Y'all drink bourbon? Okay, well, I got to tell you, in New Mexico, it's a huge, you can't find it. You know, they make X number of bottles every year, and one of them gets to New Mexico. I mean, we found Blanton's at the local Total Wine, and I'm literally texting every bourbon drinking friend I know, and it was gone in 5 minutes. So somebody donated a bottle of Blanton's. Well, you can't find it. If you can find it, the bottle goes for about $100 retail. I don't know what that bottle went for at that auction, but say the bottle retails for $100, but the person paid $250. Do we have a potential deduction here? The $150 over and above the fair market value. Where we get into interesting things, and I will admit to not having looked up the court on this recently, I also worked for our local zoo, the fundraising arm of our local zoo. We auction off naming rights. How many of y'all know Moo Dang? Are you on social media? You know Moo Dang, the baby hippo? Jeremy, really? It's like, okay, it's a baby pygmy hippo in Thailand, and it's like the cutest thing ever. And they're making all these memes and stuff, and it's hilarious. But we actually auctioned off the naming rights to one of the baby hippos, okay? The person didn't really get anything of any value. You know, it wasn't like Moo Dang sponsored by, Joe's Garage. It was just, we got to name the baby hippo. There really isn't an assignable value at that point. And again, have not specifically looked up court on this, but this is why we always get into these it depends. There was nothing of value really received, arguably. Could we make an argument that that was really just a donation? It was just a way to rake money off of donors? Possibly. Yeah. I mean, sometimes you're getting, you're auctioning off. I don't remember what you all auctioned last night, but sometimes you are getting something of value. Behind the scenes tour that if you had to pay for it would cost a few $1,000s, or a meet and greet with so-and-so that if you had to, cash in your Chase points would equal blah, blah, blah. Sometimes yes, sometimes no. What's the key to all of this? What's the key to all of this? I'm going to take a reasonably aggressive position and say that my client named that baby hippo and she paid $5,000 for the privilege and she's going to deduct that on her tax return. What am I going to do? You're going to ask for a receipt. What else might you ask for? Letter from the organization saying the naming rights confirmed no rights and privileges, nothing else of value. Exactly, the standard IRS blurb. So definitely, we're going to talk a little more about substantiation in a moment. Also keep in mind on those auction items, depending on what's being auctioned, somebody asked me this earlier, that the appraisal rules may apply. Membership fees, PBS. The PBS is a big one that I use as an example because they're big and well organized and most people are familiar with them. Are your PBS dues deductible? Membership benefits, when the membership is $75 or less, are disregarded. And you can bet your bippy that most organizations know that. That's why their baseline membership is going to start at $75 or below, because that's automatically going to be deductible. It's disregarded. There are specific information. What happens when you go above on a PBS donation? What do you get? But what if they're having their big drive and you're like watching the... Yeah, so if you go above that $75 minimum, there are safe harbor premiums. The IRS, and they're buried. They're adjusted for inflation. So for 2024, the safe harbor was $13.20 for token items or low-cost items, $132 or 2% of the donor's payment, whichever is less. And this is all in your text if you want to. You're like, Amber, I did not follow that sentence. Read the text. It's much clearer. PBS and other organizations like PBS have those things calculated out to the nickel. That's why, when they go up, you get a little bit better, a little bit better, a little bit better. They know where those safe harbor and de minimis guidelines are, and they're going to keep your token items within that range. What I was saying about, is it revenue ruling, RevProc, whatever, they just adjusted. They gave us all of our inflation-adjusted amounts for next year. Y'all know that? Came out earlier this week. Buried in that document will be this information for 2025. Those de minimis amounts, should you care. Oh, and we just did this one, cash donations with the premium. Sorry, I got ahead of myself. That never happens. Donating services. If y'all have ever been to like a conference with me, I have this thing. Who watched Get Smart? Y'all look old enough to know Get Smart. Donating services is a cone of nope. It's such a cone of nope, I gave you the Treasury reg in the slide, because you have no basis in the donation. I tell people, how many people have been asked by your clients who are involved in nonprofits, hey, will you donate, a free tax return or free whatever? Yeah. No basis in that donation. What do you tell your clients? Let me just write you a check. Your clients who are small businesses will often come up to you and say, well, I had a client who, she's big into like animal rescue, domestic animal dogs specifically, and she does pet photography. And she wanted to do this where she took the pet photography thing and took that as a donation, and I'm like, that's not going to work. You have no basis in the services. So what you need to do, and why this sucks for you, is because we have a gross receipts tax on services in New Mexico. So you have to basically take the payment and then pay your gross receipts taxes on that and then donate your proceeds. Yeah, no, unfortunately, yeah, no sweat equity. Not good. Possible exception, services as a volunteer. What's the kicker on this? The client has to track it. They have to pay attention. Let's say they work in a local soup kitchen, something like that, and you have to wear a uniform. Those could potentially be deductible. Are the uniforms in my picture going to be deductible? I would say no. Why would you say yes? I like my classes to be a little bit of a discussion. The reason I say no is, have y'all heard of the ABBA costume thing? That to be considered a uniform, it can't be suitable for daily public wear. Okay? So today aside, I normally wear stiletto heels when I teach. I have a broken toe, so that's not happening. But with my stilettos, that's part of my uniform. It's part of my deal. They're not deductible. ABBA made a successful argument that their costumes, they wore such crazy, y'all know who ABBA is, right? I'm looking at these faces and I'm thinking you know. So their costumes were so outlandish that they would never be considered for daily general use. And that's what you have with these t-shirts. Just because it says volunteer on it doesn't mean you aren't going to throw it on to go grocery shopping or to the car wash. That's why those, that's why branded polo t-shirts are not necessarily deductible as a uniform. Now, are they deductible as a marketing expense? That could be arguable. Oh, well, I'm, getting the name out there, whatever. Okay. Kind of depends on how aggressive you want to be. I don't have a court side on that, so if anybody has, let me know. So mileage, if they track it, their mileage to and from. We have, and Helene, this would be a good example. All those people that are driving from here, how many of you know Kevin Houston? People that are driving from here, truck and supplies, down to Kevin in Asheville. If you're taking it not to Kevin, but to a charity, like the Red Cross or a local charity, 501c3, that mileage is going to be deductible, which if you're driving a fully loaded F-150 could be significant. Meals and lodging, subject to two code sections, the additional substantiation requirements for meals and lodging of 274D, and the IRC 162 requirement of being away from home. Y'all know what 162 is? I teach the Learn to Code class. I want to know if you guys know your code sections. Trade or business expenses, when they're deductible. They have to be ordinary, necessary. But 162 also has this away from home requirement. And I want to say off the top of my head, it's 50 miles. And that there has to be a reason for you staying overnight. It can't just be, well, Saratoga Springs is such a lovely place and I wanted to hike. Donating cash. Now we're getting into substantiation. Cash is king. You have to prove that the donation was made to a qualified charitable organization and the amount and the date. Well, cash is king for a reason. It's largely untraceable. So what are we going to do? If it's under $250, and this is what I was talking about earlier when I was speaking about sometimes we overkill. Have y'all seen those charts? I'm going to put that down before I accidentally click on something. Have y'all seen those charts where you're buying something online and they have a series of features going across, and then they have your gold, silver, bronze level going across this way, and then they have the X's, okay? The substantiation requirements for charitable contributions work much the same way. Except the substantiation things are running down the left-hand side, and the amount of the contribution is what's running across the top, and the higher that gets, the more conditions get tacked on for what is considered adequate substantiation. So under $250, a canceled check or a credit card confirmation from the organization will do. Over $250 requires a contemporaneous written acknowledgement in addition. So this also works like the chart. You can't just give them, thanks Thanks, Joe or Henry, for your $50 donation, because a lot of times they'll use, your name. Or thanks, Mr. Smith, okay? You can't just substantiate with a stack of letters. Much as with proving a business deduction, you also have to have proof that you are the one who made the payment. No substantiation means no donation if it's examined. Cash into offering plates or donation buckets is a no-go. I got really liquored up at the thing last night, and Salvation Army was out there ringing their bell, and I threw, all my Benjamins into that bucket. I have, even though I could say the date, and I could probably give credible testimony, and I could bring in witnesses to say, yeah, Amber was feeling really happy and generous last night. It's not going to happen. We also have a situation where stuff can be cash. In certain circumstances, stuff can be cash. If it is purchased directly on behalf of the qualified charitable organization, F-150s full of bottled water being trucked to a 501c3 in North Carolina or Florida. You purchased all that bottled water specifically to donate to that organization. It requires the exact same type of acknowledgement, but it is like donating cash. Questions on that? The school supplies is another very common one. Schools, normally elementary schools, or there are other qualified 501c3 organizations where they, have school supply drives. You do have to be able to prove that you gave it to a qualified organization. So again, even if you bought it at the grocery store, the Thanksgiving meal thing, you bought it at the grocery store and you dropped it in their collection bucket for people who are food insecure, you can prove the amount of your purchase. How do you prove that it was done to a qualified charitable organization? We haven't seen this court tested yet, okay? Something I would tell my clients is it's getting that to be that time of year. If you are donating school supplies into a bucket, or books into a bucket, or food into a bucket, or cans on top of the mailbox that you went out and bought, and we're going to get to that in a minute. What I would do is I would take a picture of the flyer. I would take a picture of, most of those buckets have like a banner or some kind of placard on them. And we hope, obviously, that this is never going to be court tested on behalf of our clients, but it proves that you did your due diligence. Yes, I allowed them to take this, they handed me a receipt, but I asked for proof that it was done to a QCO, and they showed me the selfie on their phone of them putting that bag into the bucket, and then I've got a close-up from the phone, and that's in their tax file, and you have done your due diligence, you have covered your assets and theirs in the event that a small contribution like that were to be examined. Now, consequences of failure are pretty low. Your $25 contribution is disallowed. Who cares? Okay? It's a difference. Did somebody just say it's a principle of the thing? Jamie, yeah. Yeah, it kind of is. It's us, again, showing that we know our stuff, we're doing our due diligence, and we're conscientious tax pros, not just throwing this stuff out the window. And again, to go back to Brad and, who are those guys? Brad, Matt, and Josh, that's right. They're always, yes, thank you. I was just going to say, let's call them the Three Stooges. They're always taking pot shots at me in their classes. Okay, so you're saying, oh, Amber, this is a lot of work for not a lot of return. This is where the automations come into play. This is where those automations come into play. You use the robot overlords to write an email or a little blurb about, here's what I want you to do, and here's why, and you use Zapier to hook that to your automated mass mailing software, MailChimp, or whichever one you use, and send that out. Add it to your monthly newsletter. Get your clients in the habit of substantiating their stuff regularly. I have great clients. My clients know. They just do this stuff. Why? Not because they were born knowing it, and not because they want to do it, but because I drill it into their heads in the nicest way possible. Stuff can be cash. $50 a month for student living expenses. It ain't much. If you're hosting a foreign exchange student, it has to be a full month, but in IRS math, that translates to 15 or more days out of the month. The student has to not be a relative or a dependent. A lot of times, if the student you're hosting is your relative, sometimes that person would even qualify as a dependent. We're not going to go there. Has to be grade 12 or below. So most of the foreign exchange student type things come in from a high school, visiting student swaps. It can't be secondary ed. They have to live in the home under written agreement with a qualified charitable organization, educational opportunities. That is, if you see the asterisks, all three of those have to be met or there's no deduction. That's an and, not an or. It's not 2 out of 3 ain't bad. And there's also a 30% AGI limitation. Although if you do the math on that, I mean, you'd have to be hosting a lot of kids, okay? I'm saying to hit, anyway, you get where we're going with that. Everybody's favorite. That's almost the closet of my dreams. Donating stuff. The value of the donation is almost always fair market value. This is the one that's most commonly misunderstood by our clients, right? Oh, same as last year. Oh, just take the max. You know, you guys aren't nodding, but I know some of you are laughing because I know you've heard this. This one is possibly even more misunderstood than, or is probably more misunderstood than donating services. There have been some really great court cases around this. Fairly recent one was the woman was buying clothing on sale, 75, 90% off, clearance bin stuff. I mean, and there's just like so much failure in this mindset. And again, taxpayers don't know this. They think they found a loophole. Hopefully none of your clients. But the woman was buying stuff at 90% off, immediately donating the brand new clothing to a 501c3 who accepted clothing, and she was taking the full tag price. So sweater, $100, she paid $10, she took the $100 as a donation. It was a huge failure. It went all the way to tax court. I'm sure it was quite a shock for her because she had in the 5 figures worth of donations. And again, we're back to this is not a tax credit, it's a donation. You just spent a bunch of money to get pennies on the dollar, and now you're not even getting those pennies on the dollar. It was bad. And here's an interesting thing about, if you talk to me, I'm a new hunter. My husband's an old, really old hunter. Taxidermy, donated by a taxidermist, only get what would amount to the cost of goods sold. There was another great court case that involved an appraisal and testifying by an expert testimony, where the guy donated his taxidermy collection and had his friend, who was the taxidermist, appear in the tax court as an expert witness, that, you know, this taxidermy collection was just worth millions and millions and millions of dollars. And I think it was Judge Holmes, and I think it was really hilarious because a taxidermy was like, kind of like if you've ever seen Psycho, something out of the Bates Motel. But taxidermy is one of those oddball exceptions to this. Stock. You can how many of your clients donate appreciated stock? Yeah, that is a great option, okay? The benefit of that is you can take full fair market value. Well, you've got to have, you know, you got to have your proof, you got to be within your income limitations, yada, yada, yada. What's your other provision there, dude? Long term. Yes, it does have to be held for a while. So, you know, typically that's going to happen. You know, you bought Apple stock back in the 90s, and it's gone up, and you're just like, hey, I can get rid of 5 shares of my Apple stock and make a really big contribution to my favorite charity. Great way of doing that. What if you want to donate a dog, something that lost money? Your client comes to you and they're like, I want to just donate this stock to this charity because it's losing money, or I hate this place and blah, 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 blah. Do you tell them to donate the stock? Why? Why? Sell it and take the capital loss. Excellent. Vehicles, all the fine print on the vehicles is in your text, and I'm assuming you guys know most of it. Depends on what the charity is going to do with it. If it is, say I was asked about a collectible car, we're going to talk about appraisals later. If the car is collectible, and depending on the value, or if the car is an antique, how many of you guys took my Cash in the Attic class last November webinar? Did you have fun, Henry? All right. It depends. There are different rules for antiques. There are different rules for true collectibles. True collectibles are defined in IRC 408, which has to do with retirement funds, 408M, I believe, because there are things that are prohibited in retirement, tax-sheltered retirement accounts, and that's why collectibles are defined there. If you didn't take my class, interestingly enough, things like baseballs, vintage Pyrex, lots of things that people collect are not collectibles under the Internal Revenue Code. Just be aware, you should probably look up the fine print if you think it's a collectible to see if it is. Collectibles do include any antiques, and the law on antiques generally is 100 years or older, and if you want the why of that, that's in my other class. Land and real estate. Donations of partial or future interests in real property can be tricky, and they are subject to some limitations, which we're going to discuss. Conservation easements, who has clients doing them? Donating to them. Henry? I'm of a different opinion than Henry. Henry says run, don't walk. I'm firmly in the it depends camp. Conservation easements, do y'all know what they are and how they work? They're being aggressively marketed to high-income taxpayers as tax donations, but what do they all hinge on? Valuation. Okay? So much in our tax code, and the reason the IRS doesn't like them is because the more aggressive, less reputable marketers of these transactions are out there pushing these things, and they're assigning really high values to property that maybe shouldn't have that high a value. So they're passing through to their easement partners a big chunk of donations, and the donation really should be a much lower percentage. It's important to know on that, and those are what we call the syndicated conservation easements. You can often donate to just a conservation easement as an individual, not part of one of these partnership structured easements, a syndication. If you want to donate the land that abuts your farm, or you want to donate your farm but not the farmhouse to the Nature Conservancy so it can go back to wetlands or whatever, that's not a syndicated conservation easement. There are really great ways of making conservation. If y'all know Tom Gorzinski, Tom's like me. He's not a fan of syndicated conservation easements necessarily, but there are legitimate organizations and legitimate ways to donate a conservation easement that the IRS, they may question, but it will be easily defended. However, when it comes down to valuation, the taxpayer is going to have the burden of proof. So if your taxpayer is an individual donating a big chunk of the family farm, not such a big whoop. Chances are, at a minimum, you're going to be able to do the old standby of here's what the county assessor said for property taxes. When it comes to those syndicated, you got to get a hold of the people and say, how'd we do the valuation? Did you have a qualified? How'd you come up with that number? Yeah, it's like asking, it's like when you get a wrong 1099 from one of those big corporations, and they're like, oh, call the issuer and get that fixed. Same principle. It doesn't happen. Yes, sir. We're going to talk about qualified appraiser credentials. This depends on you, and I'm not a big fan of nanny state tax practice. But I am a big fan of due diligence. And I am a big fan of, can you defend it? So, can you defend it? So the question is, somebody has an easement they donated, and let's say it's part of a syndicated transaction, and you're not sure if that's a reputable, you do a quick Google and you can't really tell, it doesn't look dodgy to you. What do? You know, so it's on the taxpayer, okay? The burden of proof is not on you. The burden of proof is going to be on them if it's examined. Hang on, Henry. So what would you do as a best practice? It's not your job to go out and make sure the appraiser's qualified. But if it goes pear-shaped, who's your client going to blame? You. I mean, it's going to be ugly, and you're like, not my fault, and you have to deal with it, but it gets confrontational, which some of us don't like. Exactly. They're going to want somebody to blame, and you're close. It's not your job to do it. However, I'm big on communication. This deduction looks legit. I did a 5-second Google. Your transaction looks okay, blah, blah, blah. However, I want to tell you that should the IRS examine it, the burden of proof for establishing that this was a qualified valuation and the valuation is accurate is going to be on you, not me. And then you ask the robot overlords to generate that memo, and you get the client to sign off that that conversation was had. Because then when they come back to you and say, you never told me that, you can say, yes, I did, and now you're going to have to hire me or somebody else to represent you in this case. Yes, Henry? Right. I mean, and what Henry is saying is basically there's an ROI component here. If we're looking at a couple $100,000, depending on the taxpayer, getting a few thousand, even 5 figures worth of something disallowed. Here in New York, in New Mexico, it's a different deal. But here in New York, 5 figures worth of disallowance may not be a big deal to the taxpayer, and it may not be worth doing all the extra work up front. But I don't like to make those decisions for my clients. I like to give them information and say, here's what are we going to do, and I like to put in the file that the conversation was had, because again, in the event something were to be disallowed, you can say, I told you that this is a huge disallowance and you're going to be subject to understatement penalties. I told you that this could be disallowed. I told you that this is something that's commonly examined and that you're going to have to prove that that valuation was done. You don't do all that work. That's their job, just like keeping the receipts is their job. Non-vehicle tangible personal property. You know, this is the most common one. Household items, clothing, canned food. Canned food that you purchase, or bottled water that you purchase and put in somebody's truck and they drive it down, donate it to the Red Cross, that works like cash. Canned food that you pull out of your pantry that you bought for personal use and donate it, that's a fair market value thing. If that can's been sitting in your pantry for a while, maybe it's appreciated. I don't know how groceries are going up. But chances are you're looking at more of a wholesale type situation. They pegged the $5,000, didn't they? Yeah, I think that's the next slide. Oh, no, I didn't put that on the next slide. Yeah, it's very easy. That's in a single category. So do y'all know what Henry's talking about, pegging the 5,000? I find this happens when when older clients are deciding to downsize and move into a senior community. I have a lot of older clients, and a lot of them have really nice things. And if you've ever done this job, which is extremely unpleasant, sometimes you have to purge things in layers depending on the size of the job. And it's very easy in one calendar year to let go of things in batches. And all of a sudden you have more than $5,000, especially if you have nice furniture, where all of a sudden you have over $5,000 of goods, household items, in one category that require a qualified appraisal. They were donated in 3 batches. The client had the $5,000 number in their head. They didn't realize it was an aggregate for a calendar year. There's no way to get that appraisal anymore. What do you do? Yeah, cap it at 4,900. Your office policies are your office policies. Some folks are more cowboy than others. Some people are going to take the whole thing and say, let the IRS come looking for me. Some folks are going to cap it at 4,900 because they just don't want to deal with any potential repercussions. All I would say to that is make a policy, stick to it, be prepared for the consequences. It does not matter if they are different organizations. I don't believe. I'm going to say I don't think so. I think it's just $5,000 in the same category. Taking a look at the old notes. Nope, that's some. Okay, blood, plasma, and organs. Court cases aplenty on this one. Yours. Yours, Henry, yours. You can't take a charitable deduction for donating blood or plasma or kidney. Court cases aplenty, and they're probably in your text, but I'm going to say if you Google them. I actually have, if any of you subscribe to Think Outside the Tax Box, I wrote an entire article on donating body parts or being in the business of, it's Halloween, harvesting. Yeah. So is my blood, plasma, egg, and hair sales, are those a side gig, or did they rise to the level of a 162 trader business? I actually did a whole article on that, and it got into some kind of fun territory, but that's fully cited if you are a subscriber. The what? Mileage to the places could be deductible. Except, are you really volunteering? I mean, that becomes the question, and I haven't seen if this was court tested or not. Are you, yes, you're voluntarily giving your blood, but are you acting as a volunteer? Becomes the question. And that's why I always like to see folks, they're, it's all about accounting, it's all about the numbers. No, so much of this boils down to language and definitions and court interpretations. And there's lots of court cases out there. I mean, way too many for me to research in even a year on one single topic. Yes, sir, in the back.
Where I live, you normally get a $20 gift card and a t-shirt for donating blood.
So are you doing it out of disinterested generosity, or are you doing it to get free baseball tickets? We get free baseball tickets. So yeah, again, depends. And again, those are token items, but that does not necessarily, your blood donation per the courts is not tax deductible.
Every 8 weeks
Like clockwork, which is great, and it's a very charitable impulse, but you cannot deduct it. Here we have the numbers, the boring stuff. I'm a law girl. AGI limit, 60% of AGI for cash, ordinary income property, capital gain property that's not LTCG, and where the taxpayer is electing to use their basis rather than fair market value. 30% AGI limit for donations contribute for the use of the charity. So is the charity going to use that stuff? Okay, so you donate the canned goods. That's a different limitation. I'm looking at this. Also, you've got certain organizations that are not what they call AGI limit organizations. Explained much better on your text than in this slide. But veterans organizations, fraternal societies, et cetera, are subject to this lower AGI limit. So you can donate to them even though they're not necessarily 501c3, but they're subject to that lower AGI limitation. Which, have you ever had a client ping the AGI limitation for charity? You have? Oh, okay, cool. I've got some extremely philanthropic clients, but I've never had one get close. Does there nothing? Yeah. Okay. There's 30% limitation on capital gain property, lesser 30% AGI, blah, blah, blah. The thing that you might miss here is it's less the other contributions. So there's ordering rules, much as there are ordering rules elsewhere, okay? You have to take into account the effect of the other donations hitting the AGI, and then you've got to look at that 30% limitation on capital gains. So it's a lesser of 30% of AGI or 50% of AGI minus everything else that came before under the ordering rules. 20% limitation on capital gain property to a non-AGI limit organization, your veterans, your fraternal societies, etc. 50% AGI on non-cash. 50%, why have I forgotten what QCC is? Some of us are, things flying out of my head. Qualified conservation contributions. It's a specific definition. There's a 15-year carry forward. And that's legal. That would include a legal syndicated conservation easement or any conservation easement that's not syndicated. The amount of the deduction is limited to 50% of AGI minus the other contributions. However, I live in farm and ranch country. Y'all have farmers and ranchers? You do? Farmers and ranchers, let's say nobody wants to take over the family farm. Nobody wants to sell, for whatever reason they can't sell the family farm. Farmers and ranchers can take 100% of AGI as a deduction on a qualified conservation contribution. How many of you just love this one? 8283. What do y'all do about this? What do y'all do about this form? Do you fill it out for your clients? Okay. You'll do it with just a receipt? Okay. I have clients. Well, see, I had some clients who remember the engineers, the rocket scientists? Yeah. Can you explain every single line of my return? No. I can explain it to you. I can't understand it for you. That's what I tell them. But I have had clients give me beautiful spreadsheets for their to substantiate their 82, 83 contributions. Here's where your robot overlords come into play. I stripped the information out of those, kept the headers, and I now use those as a template for any client. I'm like, oh, your things went over $500. We can take $500 instead of $560, or you can fill out this spreadsheet and let them choose. I also keep a database, and God love him, Brad would probably have this all automated, but I have a database of the EINs for our most common charities that I see in New Mexico. And so if somebody pops into me with something and they don't have the EIN, I will often go out and Google it. I'm an it depends kind of preparer. If it's one of my, when I say old, I do tax returns for really elderly clients. If it's somebody that's going to struggle for any reason, disability, age, whatever, with finding that EIN, I will look it up for them. If it's just rando that could be doing their own homework, I send it back to them. And honestly, your mileage may vary. I have a very small kind of boutique tax practice as far as return preparation. If you're doing higher volume, your policy may be, I'm not going to do anything over $500 without an EIN. But the way you get that to your clients without getting a lot of pushback, communicate early and often. Hey, I see a lot of you every year are donating and you come in with, I think I have a picture of it. Those blank, nope. Boy, I really did a fail on this. Those blank receipts. They come in with the little tech. Although now they're QR codes. Did you know that? They're going to my local Goodwill, you scan your thing and it's supposed to give you some receipt. Yeah. Can we have a paper copy, please? So, again, with the best practices, communicating to your clients. Periodically, monthly newsletter. Hey, charity comes up a lot during filing season. By the way, Here's what you need to know. I noticed that as NYSSEA, you get a discount on your tax book products. Did you know the tax book has a great set of client handouts? At a minimum, they're fairly inexpensive. You could purchase those handouts, and sometimes you could just hand those to clients as a reactive measure, but typically what I do is I do client updates throughout the year, just kind of what's going on in the office, and I remind them that over $500 is going to require extra form, which is also going to cost them more money. It's not included in my 1040 prep. Over $5,000 of non-cash for C Corps, you've got it. Filing it with the entity return, blah, blah, blah. You guys can see all that. We talked about the group of similar items. Publicly traded securities, you're going to put those on there. Vehicles, intellectual property, and inventory. Section B is going to require that appraisal for your non-cash. Okay, and we're going to get into that. Gentleman had a question, but he left. Oh, his computer's still there, so maybe he'll be back. What you got, Henry? There's a huge amount of detail in your text as far as inventory. Things have to be, if you're, especially what we get is restaurants donating food or grocery stores donating food. Boy, there's a lot of gray there. The food to be donated at full value has to be, oh God, the words are in there, Henry. It's like fresh, or you can't be donating stuff that's like right on the edge or past its born on date, things like that. It's the smaller of fair market value or the donor's basis. Perhaps there is an exception, but when I was reviewing for this class, fair market value or the donor's basis, which is often wholesale. Kind of depends on who's doing the markup. And again, there are special rules for food inventory. And there's a little bit differences whether it's an individual or a corporation taking it, but both of them can. Let's talk about appraisals. So this is a fun little thing for electronically filed returns. Section B, Part 4 of the 8283 has to be signed by the appraiser. I've never had this happen. But how are you managing that on an electronically filed return? Or you can attach it. And that's what I would do, is I would just file the 8283 electronically, but I would also attach the signed copy if it was signed by the appraiser. Keep in mind that there is a much lower level that requires an appraisal for anything that's not in good or better condition. And this is weird and I don't like it, but I don't make the rules. They're assuming that anything that's not in good or better condition is an antique or vintage, and that's why it's valued at more than $500. So I have an old car or an old dresser that is an antique, but it's a little banged up. But, you know, Antiques Roadshow says it's worth whatever. Stop snickering. If it's in fair condition, because it's antique or vintage, clothing is another big one. I have a Birkin bag from 1980, and well, I used my Birkin bag, but those things appreciate, but I'm going to donate it anyway. And the Birkin is worth a couple multiples of that $500. That's going to require a qualified appraisal, because even though it's just in fair condition. Any questions on that? We're going to get into what's a qualified appraisal here in a minute. Let's talk about the record keeping. We talked about substantiating. Cash, we talked about it. Stuff, less than $250. Receipt or reliable written records, we talked about some best practices for that. Have them take that snap, those selfies, and just pop those into the file. Communicate that in advance, not after the fact when you're busy and they start feeling pressured. In between, you have to have everything plus that contemporaneous written acknowledgement. Y'all know, stuff, $500 to $5,000, all of the above, plus. And this is where 8283 comes in, is I don't know about you, I use Drake, When you start filling out the 8283, it doesn't tell you that how the property was acquired, the acquisition date, and the cost only apply to anything over $500. Okay? You got to get, in there and... How many people even have this? I mean, fortunately, most people that donate stuff do not remember when they bought it. I donate a bunch of my dad's stuff. I was like, I don't know. How many people remember what they paid for it? Unless it was special, they're not going to. Back to best practices. Who's doing the estimating? Who's throwing in what their basis was? Is there rule of thumb? They're donating $800 worth of clothes to Goodwill over the year. They were all acquired by purchase, but they don't remember how much they paid for them. What am I putting in as their basis? There is no rule of thumb. I mean, it's nice to just say, oh, well, probably 50%. We're just going to throw in 50%. Don't put that number in there. Train your clients, make them tell you, and if it looks hinky, make them explain. I had a client whose husband passed away. He always did their taxes, but she came to me and she donated a ton of his clothes. Not enough to trigger the appraisal requirement, but suits and shoes and briefcases. And it was easily probably $3,000 to $3,500 worth of stuff. And it's like, how did you come up with this? Well, there are ways. The IRS has resources. The tax book has resources. There are valuation guides. But when you ask what they paid for it and they don't know, you want them to tell you what the estimate is, and you want them to tell you how they came up with that estimate. And again, they get snippy if you're doing this during tax season in order to finish their return. So be proactive about explaining to your clients, if you have clients that donate stuff regularly, what that's going to entail. Here's our qualified appraisals. They're required for each item or group of similar items valued at more than $5,000. There are certain cases, and you will see these more frequently in New York than I do in New Mexico, where the appraisal has to be attached to the return. If it's art and it's a single piece, or there are multiple pieces and it's valued at more than $20,000, it requires the appraisal and it requires photos. I have never had a client like this, but if it's an item or a group of similar items more than $500,000, more than $500,000, that appraisal has to be attached to the return. One would hope. How am I doing on time? Okay, we're going to get there. Again, with the vintage clothing, and if you're donating a qualified easement on a historic building or structure, you got to prove it. You got to prove it. Qualified means it's performed by a qualified appraisal. Here's one where they're going to fail. It's provided to the taxpayer in writing. You with the car, did they get the appraisal in writing? Do you know? Okay, so it has to be written. It has to be signed and dated up to 60 days before the contribution. It has to be made, you can't have, God, the word just flew out of my head, but post-dated, retroactive. You cannot have a retroactive appraisal made. You got to have a plan. And again, that's why make sure that your clients don't feel weird about contacting you. Brad talked about this yesterday. How many of you were in the engagement, the retirement planning? You got raised your hand before. He talked about making that a separate engagement so that people were constantly planning. I don't do a subscription service because I get a lot of client pushback on that type of thing, and quite frankly, I'm the type of client who would push back. I want to pay you to do my taxes, and that's that. However, my price for a full service return prep is higher than many, many places in my general area, because I build in an hour and a half of off-season consult time so that my clients aren't afraid to call or email with a quick question. And they get their quick question. They get their quick question for free, and it gives me a chance to be very transparent to them about, this is not going to be a quick question. This is going to require research, which requires you to purchase a block of billable hours for consult time. Because you're a client, you get a discounted rate for that. Brilliant work around what Henry said was he had a client, and it was kind of an after the fact, and when he realized that they weren't going to be able to get the appraisal timely, he had the donation loaned to the institution temporarily, which bought them enough time to get a current appraisal. That's a great option. The appraisal also can't be, much as you can't base your fee on the refund, the appraisal cannot be based, obviously, there's a huge conflict of interest there to inflate the value of the item. Qualified appraiser has to be a recognized designation from a recognized organization, or, and that's an or, minimum education requirements and 2+ years of experience. They have to have some kind of training. Okay? It can't just be, Cousin Joe's been fixing these kind of cars for years. He knows what it's worth. Let me tell you, my dad had a friend. We're not going into that. All right? It's like, that car is not worth anywhere near that kind of money. I don't care what so-and-so says. Exactly. No positive. Henry's up here quoting my cousin Vinny. Okay. So, trade school, professional organization classes, or actually college. They have to regularly prepare appraisals for pay. So again, the mechanic that's working on the car, that's constantly doing the Google and stuff, if they're not really in the business of preparing appraisals, they're not going to qualify. It is. So there has to be a declaration of their experience and education specified in the appraisal. Here's what makes me qualified to give you a value on this. Oh, I normally appraise poster collections, but that looks like an old master, but I'm an art appraiser, I can do that. No. I get asked that every time I do a class, and I have no good answers. I looked online for a client to get some art appraised, and there are appraisals, there are appraisal organizations who certify appraisers, but it's going to take a lot of legwork. And I would recommend that you put that legwork again back onto the client. Give them the information they need to secure a qualified appraisal. Document the fact that you did that. Have them get the qualified appraisal. Appraisal is probably, most cases, is not going to have to be attached to the return, but you're going to keep a copy of that appraisal on file, and you're going to keep a copy of your due diligence as to how the client chose that appraiser and that you gave them the requirements. It's just like auditing their books. You don't have to get into every single nut and bolt. You need to do enough due diligence to keep yourself safe. We had the conversation. I told him to get a qualified appraiser. He said he did. Here's who they are. It's in the file. If the IRS wants to get all up in their business and decide the appraiser's hinky, you've done your due diligence. Did you have a question? That is not a qualified appraisal. Not when you're looking at something that has to be appraised. It's not like real estate where you can just go out and get comps. And the juice has to be worth the squeeze. So if you're looking at those low-level valuations for filling out the 8283, eBay would probably be a good choice. And saying the client told me fair market value was this, and I've attached some eBay snips in case anyone ever asks. Great practice. Great practice. But when you're talking actual appraisals, the juice has to be worth the squeeze. It's got to be a big dollar figure, and you got to do the due diligence. And if you're doing that to that level with your client, bill for the time. You billed for that time, I hope. Yeah. Okay, so now we're going to talk quickly about strategies. We're going to talk quickly about it because I know you guys had a whole separate presentation, 5 minutes. QCDs. You don't have to itemize. People miss this all the time. They're philanthropy. Older people with RMDs going to church that want to tithe. Have them take those QCDs right out of their retirement accounts instead of writing the checks. It keeps it off their AGI. It's fabulous. They can do up to $100K a year. We're going to talk briefly about qualified remainder trusts. They can even do a one-time contribution of $50K to a charitable remainder trust directly from their retirement account with the RMDs. Bunching, y'all know about bunching? Every other year. Your tithers hate this. They feel like, God is watching, and they don't, I'm not doing it for the tax deduction, I'm doing it to support the church. Every now and then you can get a tither to just like, can we talk to your church, tell them you're going to donate, and it's supposed to be good for 2 years, and blah, 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 and you can get that. But I have a couple taxpayers that make donations to their alumni associations, and they work directly with their colleges, and they've explained, you're going to get this donation every other year so that I can itemize every other year. Tax Cuts and Jobs Act, who knows where that's going to go? We won't go there. Donor advised funds, there's quite a bit of information on this in your text, so not going to go over it too diligently here. You have to get an acknowledgement from the fund sponsor that the sponsor has legal control of the assets. You can't do a donor advised fund if you're in there bossing around where things are going after the fact. The good part of this is, let's say your client's having an exceptional year. They can do a huge donation to a donor advised fund in 1 year, and they can advise, they pick their charities, and they can advise on amounts over the next several years. It's like one donation, whole thing up front, and then the donations actually trickled out to help the organization's cash flow over multiple years. Charitable remainder trusts. There's CRETs and there's CRATs. So the charitable remainder trusts are ways for your taxpayers to both make the donation, your donation receipt, things in your book, make the donation, but also have a source of income. We saw that you can make a QCD into a qualifying trust. Details in the book, but qualifying trusts can't have any contingent beneficiaries. It's just got to have one level, okay? Your assets are transferred into an irrevocable trust, and depending on how the benefits are paid, the trust is going to pay you, the donor, or your client, the donor, a certain percentage of the value of the trust, and then everything else is saved, and whatever's left over gets donated to the charity at the end, okay? A CRAT is a charitable remainder annuity trust. Instead of distributing cash directly, annuities are purchased with the funds that are donated or put into the trust, and then a percentage, the donated assets are sold to get annuities, and the non-charitable beneficiary of the trust is receiving income from that the annuities are producing, and everything that's left over when they die then goes to the charity. And there are specific rules. There's almost always going to be some kind of taxable income to the beneficiaries on these units, okay? And they're going to get a K-1. These work best for high net worth clients because threshold for administrative pain. You're not going to get a lot of ROI. There's administrative cost of compliance issues. At a minimum, you're going to have a 1041 here that's issuing a K-1. So you've got to consider that. And again, I don't have clients that would benefit from these kinds of things as a planning strategy. If they come to me, we have a serious conversation about what this is going to cost you to set up. And again, is the juice really going to be worth the squeeze? Henry, did you have something? The other thing you've got to consider on those, what Henry said is you can have substantially appreciated assets, which makes a lot of sense. You've got real estate in California or somewhere, Claudia knows, go way, way up. Or you've got really appreciated stocks. You can put this in, you take it out over long. It's going to work better if you're really rich and really young. So you can take it out over the life, okay? But again, what happens when the kids, hopefully you're not involved in this, but when the kids come looking for the house and it's like, oh, we put that house into a charitable remainder trust. Your clients that want to explore these strategies have to be your philanthropically oriented clients. They have to be committed. It's not for the, oh, I want to lower my taxes, can I make a donation type of clients. These are things that require planning. My kids are taken care of, this is what I want to do with the rest of my money. Or I have no kids. Or my kids are jerks and I don't want them to see a dime. Or my kids have been squabbling over this and wishing for my death for the last 15 years, and I've had a gutful, so here's what we're going to do. Lots of options, but you definitely need to make sure with the client when they want to explore these that it's going to make a difference. Any other questions? Yes, juice may not, as with so many things, IRS. For the people that are exploring Kretz and Kratz, that one-time $50,000 QCD, you might as well, it's walking around money. It's a rounding error. So yeah, it may not be worth the hassle to even do that for that low amount of money. It may just be better to take the whole $100K and pop it into, wherever your charities that you want to go. Good point. All right, that's me. I put my bio at the end because they usually introduce me. I am available on social media. I still call it Twitter. I'm available on LinkedIn. I say tax journalist, so the finance bros aren't contacting me wanting to go out for coffee. You are welcome to email me. This is my personal Gmail. It's my personal business Gmail. If I speak at a conference and I have a client email that's branded, okay, with my domain name. But my Gmail is anybody who's attended a class, met me at a conference or whatever, you're welcome to email me at this one. It follows me everywhere in my phone pocket. And I will get back to you. And I've joked. I even will sometimes, small boutique practice, if you have a really weird research question or something, need a gut check, I'm the person that's not too busy during tax season, even close to the deadline, to get back to you. Especially if you say, I attended your class and you were so awesome, Amber. And there's my website. Eventually it will have my future speaking engagements on it, but it doesn't at this point.
What's the 505?
505 is the area code for New Mexico. Tax therapy wasn't available as a domain, so I had to add something to it. And so 505 is the area code for New Mexico. That's where we're at. As opposed to 575, which is rural New Mexico. 505 is Albuquerque, Santa Fe. Any other questions? Thank you all for coming. I know some of you need to catch flights. Thanks, and I hope to see you again, maybe next year. Whether I'm speaking or not, this is one of my favorite places to be.